right, let's get on with the show. I don't know if I said it, but I'm Greg Owen, the CEO of the GoCo Group, but I'm sure most of you know that. Okay, let me just tell you about Phil Anderson. Look, I first came across Phil Anderson when he did a debate with Harry Dent maybe 4 or 5 years ago. Phil is one of the most respected analysts, and also he had a huge following in the Port Phillip Publishing Group down there in Melbourne, a massive following, and he and Harry had a debate. A huge crowd turned up for that debate, because then I realised that obviously Phil Anderson is somebody special. And sure enough, you know, he's an authority on real estate, the share market, but especially the real estate market, because what he had to say that day to Harry when they had a debate really, really resonated with me, that this guy knew what he was talking about. And we're going to talk more about that in the minute. And especially he talked about his 18.6 year cycle, which we'll talk about just in a moment. But Phil, thanks for joining us this morning.
You're welcome.
Phil, just to kick the show off, you know, you are famously known for this 18.6 year cycle, and which obviously helps us look at real estate prices over the past 20, 30 years. It talks about real estate prices now, and also talks about real estate prices going forward. And of course, we've had all sorts of analysts tell us what they think of real estate. I've had people on my program telling me since 2011 that the real estate market was going to implode in Australia, but it hasn't done that yet. It just keeps on keeping on. We're in very interesting times with COVID-19. Who knows how that's going to play out? Everybody's trying to look into their crystal ball and find out how this may affect everything. But of course, you have been strong. You've stayed by your system. You've stayed by your research. You've stayed by your cycle. Can you maybe give our listeners, what is this cycle? What's so special about what you do, and why have you been so right?
Greg, it's pretty simple. The economy has a structure, and it's all based around the enclosure of the economic rent. It goes back to the days of David Ricardo in 1810. I'll be brief when I talk about that, because that's way too back really. But David Ricardo made himself famous for the theory of comparative advantage. It just means that nations, if they're specialists in producing something, they should stay that specialist and then manufacture and make as much as possible, sell it overseas, and then buy in what they can't make themselves. When nations do that, they make themselves much wealthier than trying to produce everything themselves. Ricardo proved that. He then went on to study the theory of rents, and he came up with what he called how rent gets enclosed. It produces what he called a margin, and from there you get a system of economics that we see today. He also noted that the rents have behind them a very large vested interest. These vested interests are very significant rent collectors around the world. They're in the pocket of government. They run government really. And Ricardo's theory of rent was quite deliberately written out of the economic textbooks around about early 1900s, 1910 or so, when there was a very large land reform movement that swept right around the world. First World War came along, and after that we all forgot. John Maynard Keynes came along after the terrible depression of the 1930s, and he said that government can spend its way out of recessions. So that's what we've been doing ever since. But no matter what happens, if you always go back to Ricardo's economic rent stuff, you'll know that and Winston Churchill was another big proponent of rents and what it meant. You'll know that every time society introduces a new benefit, or every time governments or the reserve banks these days attempt to pump up the markets with more spending, more money, more printing, Ricardo showed quite conclusively that every time that happens, the benefit will be taken by land price. So the more we spend, the more we develop, the more we create, the more we invent, it must push up land prices. Now this all gets back to, in the finish, earnings, and of course today I'd like to keep this fairly simple. It does all get back to earnings and interest rates. When interest rates go lower, property prices must go up. So that's the general economic rent story. It's a bit like economic rent is to economics what gravity is to science. We all know about what gravity means and stuff. We all know it's science. We all know, you can see a pencil here. If I was to drop this pencil, it's going to hit the floor. That's because we know science works. Well, it is the same in economics. It's the theory of economic rent, and rent takes the gains, except that because there's vested interest behind it. If there was a vested interest in gravity, we'd not have heard of gravity yet. So that's the theory side. That's the economic rent side. I read a book back in 1991 called The Power in the Land, written by Fred Harrison, which forecast 7 years in advance the recession that the world had then in 1991. Fred wrote the book in 1983. That mightily impressed me because it was happening right at the time when I was reading it. So I decided that if I could build on what Harrison had to say, and I could work out how that worked, I could then apply that theory into markets, stocks, real estate and things. I wouldn't have to work for the rest of my life. As it turned out, Harrison was right. I went on to write a book. The book's called The Secret Life of Real Estate and Banking, which I know you've seen and heard about. And since then, in that book and what Harrison had to say and myself, Harrison studied the UK market. I went on and studied the US market. When I looked at all the US statistics, real estate, banking, interest rates, everything else, I discovered there was a very clear 18 to 20 year cycle in United States real estate prices. And every 18 to 20 years, and that's been a fact since 1800, the United States has seen a significant downturn where property prices collapse. And when that happens, everybody panics and you get a recession and or depression. The recession, how low the recession goes depends on how much money printing takes place in the few years before it. And so here we are today where, I wrote my book come out in 2007, 2008, forecast the real estate would collapse into 2008, 2010. It also forecast that we get another recovery again and we go on to bigger and better things. I said that governments would print ever increasing quantities of money, and we just get another big huge boom after the bust. And 18-year cycle, 18.6. I've worked it out at 14 years up, 4 down. Since the Second World War, since 1955 in the United States, it's quite hard to believe, quite impressively. That's been almost exact. 14 years up, 4 down. Real estate in the United States bottomed in 2012. The stats there on that are pretty clear too. Greg, it's just pretty simple. It's so simple nobody believes it. And as you know, you've seen all my past work. I spoke with, the old Port Phillip, they put out my stuff. I had a big talk with Dan Denning in 2013. I said in 2013, Dan, I looked him, Dan and I were talking, I looked him straight in the face. I said, Dan, US markets in 2013 is at all-time new highs. This is very early in the cycle. When US stock markets go into all-time new highs early in the cycle, it forecasts an absolutely dramatic upswing, which will run 14 years from 2012. That's on my YouTube channel. You can see it. Everybody can read that, see that for themselves. It's all there, black and white. And here we are, halfway through.
Bill, you are the only one saying that. You're now saying to me that real estate in Australia, and I assume this mirrors around the world, or we copy them. You're talking London, you're talking America.
Yes.
Now, right at the moment, real estate in some parts of Australia is still white hot.
Yes.
Yes. I read the other day in some parts of America, properties doubled in 3 or 4 years.
Yes. Yes. Well, Greg, it has to happen that way. It's just simple. It's just simple mathematics. First up, I hate to say this in many ways, but what happens in Australia really doesn't, in terms of the world stuff, what happens in Australia really doesn't matter that much. It's America that people want to follow. Except, of course, as an Australian investor, you do have to understand the regional variations, the regional statistics of where you are, obviously. So you always have to take account of that. But when I'm talking about cyclical stuff, the way the cycle works, America leads, the US leads into and out of. It's America you have to watch. So that's where it all happens. And Australians are very fortunate in that respect, because Australia just operates about a year behind the US. So if you look at what's happening in the US, that's what Australia just follows that 12 months later, historically. So always watch the US. I've been lucky enough to take significant advantage of all the knowledge I've built. Greg, I retired years ago. I just do what I do now for fun and stuff and watch what's happening. Let me give you just a couple of minute scenario. It's not theoretical, what I'm about to say. It's just a sort of like a small personal example. I've got places all around the world. I've lived in Melbourne for a long time, but not any longer. I've got, I have a nice house in 2 houses in France. Got a couple of places in London. The one place in London, which I bought with a mate of mine, doing some investment stuff. I won't give you the exact details, but I'll just demonstrate for you exactly why property prices had to, and will continue to go up. And it's just simple, straight interest rate and mathematics. I bought the place in East London. I paid a couple of £100,000 for it in cash, because you just couldn't get a loan back in those days. Property price from 2012, 2013, it's up practically 100% in the UK. What you do is then, because you own the property and stuff, we ended up took out a mortgage on it. Because prices went up, you can refinance that mortgage. So because we've just refinanced that mortgage, the rent received on that, just for sake of a figure, the rent received on that's say about 900 quid or so. The interest we were paying on that a couple of years back was 700 quid. Now we've refinanced with lower interest rates. We're now paying 400 quid. When that's the case, the property price must rise. There's just no other way for it to go. And so it does. So, everybody's refinancing now because interest rates have gone lower, because the Fed have wanted to save us all from a perceived another recession. All it has to do, it has to drive asset prices up. And, Greg, as I said, some years ago, as you know, when you study, and, I urge people, my book, it's only going to cost you 20 quid. It's the best investment you'll ever make. I show in that book the past 11 cycles going back to 1800. I show, you can see clearly, each cycle has been bigger than the one before it. And this cycle it's followed the script exactly. This cycle is now bigger than the one before it, the US cycle. Now we've got the rest of the world in it. We've got China. We've got China now will be almost as big as the US. So if you want to see that history and see how it all develops, once you study the history, you'll see how it goes forward. Just read the book, The Secret Life of Real Estate and Banking. It's widely available on Amazon or from the publisher Shepherd Baldwin. Every cycle has been bigger than the one before it. This one is no exception.
Well, Phil, this is fantastic stuff. Now, look, let me see.
Nobody believes it, Greg, half the time. When I put, sometimes I put out a couple of posts on Twitter, or I put it out on Facebook and other things, that Greg, the shit I get back from people saying what an idiot I am, and just another crystal ball stargazer and blah blah this and that.
No, I'm listening to you because I know 4 years ago you had every top economist saying that the market was on the verge of collapsing, and you dug your heels in and said no. Now,
yes.
Let me, for everybody watching, this is important. And by the way, what's the name of that book again? Give it to me nice and slow. People want to write this down.
Yeah, The Secret Life of Real Estate and Banking.
Okay, The Secret Life of Real Estate and Banking. All right. So according to what you're saying that real estate in Australia will continue to boom until 2026, 2027. Is that correct?
I'm suggesting that history will repeat, and the low in the United States was 2012. History shows the 11 prior cycles, it's 14 years up, 4 down. Very simple calculation. That'll take you right through to 2026. There's no caveat on that. That as plain as I sit here, Greg, that is going to happen, because I study causes, and we enclose the economic rent. It capitalises into a price. We must get a cycle. The only question remains after that: why has it been so remarkably consistent at 14 years up, 4 down? The 14 years will take us to 2026. I've been saying that, Greg. I've been saying that since about the late 1990s. If you scale that out, if you've seen my early work, right? 14 years up, 4 down. We have to. I can't say categorically that after 2026 we might get some catastrophic downturn. The downturn will depend on how much credit gets created, how low interest rates go, how high asset prices go, and how much speculation the governments and reserve banks around the world allow. Now, by all reasonable considerations at the moment, there's a lot of credit being created. There's enormous, more debt than I thought was actually even possible has now been created. So that tells you that we're on the upswing, and it could be seriously big. If we do get into 2026, and you're seeing the usual stuff happen, which is the opening of the tallest building. If somebody steps up, I don't know, let's say Trump's back in the White House and he decides to cut taxes again, and then again, give himself all the bonuses and everything else that he can imagine to all his cronies and mates, it'll just be prodigious.
Wow. All right, based on that, I've got a couple of questions, because what you've said to me is groundbreaking. It's breaking news to think that this can continue for another 4 years. So let me...
Oh, more, 5 or 6 probably. It could run, we're going to go so big, it just could run as far as possible, 2027 perhaps even, where governments just try to do absolutely everything to just keep prices high. But in the finish, there'll be an event somewhere, somehow, Greg, as we've discussed before, there'll be some sort of event take place. I've got no idea what the event will be. Nobody will forecast it, least of all me. I just know that when we get into the realms of having had 14 years up, when we get into that sort of realm, we can expect some sort of event to take place. It'll just be a normal event, most likely, but property prices will have gone so high, and there'll have been so much debt issued that everything's on a precipice, and suddenly people will decide to worry about the event that just took place, that ordinarily 10 years prior, if it happened in 2016, 2017, nobody would worry about. But if we get some sort of event like that, which people will call a black swan, but it isn't a black swan, because you have to expect that sort of event as we go into 2026, 2027. Suddenly we'll all start worrying. And, if it's an event that takes place, again, I don't know what this is, but if it's a sort of an event that takes place where the United States, the Fed, suddenly, for some particular reason, cannot lower interest rates any further, if they, I don't know, if they, just going off the top of my head here, if they suddenly have to protect the dollar, if they suddenly have to protect government and suddenly have to raise rates, interest rates, you can see how that could be really catastrophic, right? So
Yes.
that's what sort of thing you look for.
Well, given your cycle view, does the large program of quantitative easing from the central banks, the printing impact does it impact on the expected correction of the size of the fall? Does it interfere with anything, all this printing of money?
Oh, yes. Well, it just, the money, all that's happening really, if you can sort of see it from a land economist point of view, all that's happening is we're printing money and creating credit so that people can buy land price at people can buy land, or a house really is what people see, but it's the land underneath it. We're just printing all that money so that people can buy and exchange houses with one another at ever escalating prices. The merry-go-round stops at some point. We all know it stops at some point. Always try to get out before that happens.
Of course, of course. Look, is this cyclical fall unstoppable, or can the government central bank stop it? Can they step in?
The central bank is part of the system. The central bank is designed, central banks now are designed to protect the system. They're doing that for the owners of government. So, and since they've got no understanding of economic rent and how it capitalizes into a price, you know, it's not in their remit well, their remit is to protect the system, you know, so they're what you call endogenous to the system, which means they're within and part of the system. Greg, you know, I could get into, you know, I could say quite clearly that there's only two things that will stop the real estate cycle. One is a worldwide war, which doesn't stop the cycle; it just alters the timing, and that's probable. It's possible, not probable. It's possible that could happen. But, you know, remember, you know, it's in the interests of all the governments around the world now, the people that get into government, they want to stay in power. It's in their interests to manufacture enemies. So, you know, the leader of China, he loves having America as an enemy, because anytime the Chinese get a bit unstable, he brings out the bad old America. America need enemies because it keeps their military industrial complex up and running. So, you know, every now and then the US invents an enemy. Now they've just, you know, they keep telling us about the damage that China will do and what it means for the world and blah, blah, blah. It's just keeping the system operational and functional, and the Fed operates within that. It's designed to protect the system. But I can tell you, at some point, property prices will go so high, they'll no longer be affordable by productive activity. And getting back to the original question, the only way that can stop, and when I say this, people don't like this, but if you can understand why land economics and what I talk about, if you can understand why this is no longer taught at university, you'll understand why we have to get a real estate cycle. It's as simple as that. And the only way this can be stopped is by the government collecting the rent by way of a citizen's dividend or instituting some sort of land tax like they do in Singapore. And Greg, you know, like that's ever going to happen, right? I mean, it's
well, that's right. Remember the Labor government here tried to bring in some sort of readjustment on
the rent resources tax and things like that.
Yeah, on the tax deduction, and I think it was one of the big reasons they shot themselves right through the head. Yes. So I think
all government, nowhere in the world is government interested in solving the world's problems. Government is the problem. It's not the solution. And whilst government exists like it is today, we are going to get a repeat of the system. Governments are dreadful. They are pathetic around the world. Politicians even worse. Don't get me started here. The way politicians are dealing with COVID-19 is an absolute utter disgrace, especially in Australia. It is profoundly stupid what they are doing. It's the solutions, what they're attempting to do, are now worse than the illness itself. Greg, I live in Jakarta, right? Jakarta's allegedly just had a just had some sort of epidemic. I'm sure all your listeners and viewers have probably seen what the government, what we were seeing in the press, and what all the journalists, and all the TV shows were attempting to show. Right? It's way overdone here. Yes, the only reason that you saw all those queues at hospitals in Jakarta was because the prior shutdown that they'd had, or at least the prior work from home sort of issue, which I think Indonesia's handled the crisis quite well, in my opinion, because they didn't shut down the economy. But land prices are so high here, and people earn such few wages, they can't afford much, right? So the people who were getting ill, and there's quite a number of them, they had to congregate around the health system and around government-run hospitals. They've been underfunded for decades, yes? I went to the doctor and dentist at the height of the epidemic. I went to the local hospital here. It's privately run, completely empty. There was nobody there, yes? So what you're seeing on the TV and the newspapers, which I show to all my subscribers of my service, what you're seeing is manufactured. You are not getting the full picture. It's designed to be emotional, yes? And this is how the cycle happens. Once you see the cycle for what it is, once you see that it's just the enclosure of the economic rent, it gives you an unbelievable ability to be able to see through the system, to see how stupid politicians are, to see how ridiculous government is, to see how the Reserve Bank simply prop up and maintain the system. And then you realise, you see through it, you can actually then start to take advantage of all the stuff that's happening around you. It gives you, I know I talk regularly with all my subscribers. They tell me constantly, Phil, I am so happy now that I understand how the system works and that I can see through this. It gives me such a fantastic ability to relax, to stop panicking like everybody else is, and to know what's going to happen next. Greg, I can't tell you how profoundly calming that is, to know that when everybody else is panicking in a stupid fashion, you've been able to see the year before, so you're positioned to take advantage of it. It's easy. It's not hard. You just have to understand what the rent is.
I can see if we go down that rabbit hole of COVID-19, we could be here all day, but I love it.
Yes, good. Yeah, we can't go down there. Don't get me started.
We go down that rabbit hole, I'm going to get bitten.
Yeah. I don't want to belittle the circumstances. It's clearly difficult for some people. Don't let me understate. I'm not trying to say it's conspiracy. It isn't. I'm just saying, see the emotion for what it is. So, just let me clear that up.
Yes, yes. Well, certainly what I am noticing in the world media is they're not very happy about anybody asking questions.
No, it's preposterous. So, Greg, you're seeing how that's the system. It's just going to go round like a merry-go-round, and I show people how to get off, so that they can see the system from outside the system. Let you take advantage of it then.
Let's come back to your cycle, because I'm fascinated what you said. You are a fascinating person, Phil, I've got to say. And you are saying that we're going to have this perhaps peak to 26, 27. How about the fall? How deep do you see the fall? Some economists are happy to have a bit of a swing at it with the word 40% and 50% and 60% and even 70%. And obviously what you're saying from your cycles, there will be an adjustment, and then the next cycle will be bigger than the last cycle.
Yes. There's so much, Greg, I could talk about there. First up, China is getting so big now. If the Chinese government, which I think they will do eventually, if they begin to allow Chinese citizens to start investing very slowly outside of China, this will keep interest rates low for the entire century. I've been saying that for a decade as well. I said to everybody years ago, interest rates would go low and stay low, because there's just so much prodigious development happening now, and there's so much savings and so much money. Leaving aside the money printing that the US does. So if the Chinese government allows its citizens to start investing overseas, there will be such a demand, first up for bonds and secure assets, That's on the buying side. It'll keep the price of bonds, which is effectively the interest rate, it'll keep it low for years. Now, that means that asset prices just go higher. So overall, in a long-term time frame, it's a very bullish 21st century. You know, my son turns 20 shortly. I'd love to be 20 again. I'd love to be his age, because he's going to be seeing a fantastic, very productive 21st century. It's going to be tremendous. Now, the 21st century, because the real estate cycle must turn, the 21st century will be interspersed with the regular continued boom bust cycle. So as you go into 2026, or 2027, and we start seeing all the usual scenarios, tall buildings opening up, people talking about the cycle going on forever, a US politician that wants to beat his chest and say he's the greatest ever and pump even more money into the system, and we've got an obliging Fed, all that sort of stuff, which you get at the peak of the cycle. And you'll have somebody else arrive at the peak of the cycle, like who takes everybody's attention away from what they should be focused on, so that everybody gets into the cycle. You can imagine Elon Musk or SpaceX or somebody suddenly opening up investment in moon sites or something like that, and everybody absolutely gets into a frenzy. You asked me the question, how low will things go or the bust? It's not quite and will that be upsetting for everybody? It just depends on what side of the cycle you're on. Yes, and if you can be prepared for these things, and perhaps if you can take positions for the short side, you want to see the things go as low as possible. For most people going into the real estate cycle, 30% of houses in the US are being bought for cash at the moment. I think don't quote me on exact statistics, but somewhere between 60 and 70% of people in Australia own their own home, of which about a third, maybe a half, own their own home outright. The downturn for these sorts of people, it'll be irrelevant mostly. They'll still own their own home, they'll live in it, they'll still have a job. In fact, for some people, it'll be advantageous. For other people, if they've ended up investing or buying a house in the final 2 years of the cycle, and they're fully invested and they're up to their eyeballs in debt, the downturn will be devastating for those sort of people. So, from that point of view, it just depends on how you've done your investments and everything else. It'll be good for some and bad for others. Usually, the final 2 years of the cycle is a bit difficult. And that, there's always something different at the end of the cycle. And as we go into the second half, there's always something different for people to invest in. Last cycle it was all the new stuff. It was all the internet stocks and everything else. Now we've got crypto and other stuff. Yes. I'm not a big. I'm a big fan of the underlying structure of crypto, but crypto's Greg, it's one big huge con. Okay, people are going to get carried away with the whole thing. Others are issuing coins. You're seeing massive amounts of fraud, people stealing stuff. People will make money whilst it's going on. It'll be the new thing. But you watch, as we go into 2026, 2027, you'll have some of the biggest investors in crypto. They'll have pledged all of their crypto. They'll have pledged all of their Bitcoin to the bankers so they can buy other stuff. Once all the prices start collapsing, that feeds on itself. It'll be the same with all the big internet e-commerce owners. They're the big owners of stock. They'll have pledged, Bezos and others, they'll have pledged half their stock to the bank. It's the only way they can get their money out because they can't sell the stock. So they pledge it to the bankers so they can buy other assets. If the price of all those assets starts to decline below the value of the pledge, below the value of the real estate outstanding, everybody's in trouble. Crypto could, the downturn of crypto could easily lead the whole circus lower once we've gone up higher. I think property prices have to go a lot higher yet. They'll have to go at least another 50 to 70% higher, really, to cause a lot of damage. Yeah, they're not high enough yet. I know from the figures myself in London and in England and the US, the way you can get a mortgage and the way that the rent that you receive covers the interest payment. Yes, prices are just not high enough yet. We just can't get a downturn yet, but it's coming.
The real estate crumble will start which part of the world? Where will we see it? Out of America, out of England? Australia won't lead it, will it?
No, Australia certainly won't lead it. All I can say about that is the downturn will start as I show people in the final chapter of my book. It's always been the same, all past 11 cycles. The downturn begins in the weakest part of the system. And nobody will know what that weakest part of the system is, because that's why it's the weakest, because it gets glossed over, nobody sees it. But it will start in the weakest part of the system. I've got no idea what that will be. Nobody will forecast that particular thing. I just watch for the timing. And I know from my history, I know what happens in the 13th and 14th year of a real estate cycle, when in the upswing, when there's so much credit being issued. If I see those things happening again, which I'm sure they will, then I know that the downturn is coming. Where it will start, nobody can know, because if we knew, we'd have acted upon that information such that it can't start. I hope I explained that okay. So, and Greg, I can tell you from here, all right? I'll tell you now. If I knew where the weakest part of the system was, and if I knew what was going to happen, and if I knew what day it was, Greg, no offense, but you'd be the last person I tell. I'm not going to tell anybody, right? So, you know, why would I do that? It's like having the goose that lays the golden egg. You tell everybody where the goose is, and they peel it. Suddenly you haven't got a goose. All right. So, you know, I don't sit here and say categorically that I can forecast the future with some sort of magic crystal ball, right? That's not the case. And anybody who says that, they're nuts. But if you see the same behaviour repeating again, right? And we're getting this in all 11 past cycles. Just after the midpoint of the cycle, when the second half kicked off, we get interest rates lowered. We get a new type of vehicle for people to speculate in. We get banks having recovered from the first half of the cycle. They start to introduce and start to pay themselves bigger dividends. Then they start to increase credit. They start to look for people to lend to. Greg, this is happening now. Yes, it's happened at exactly the same time in the cycle prior 11 times. Yes. So if I see the same behavior coming into 2026, 2027 at 14 years up, what do you think is going to happen next? It's not a crystal ball. It's just the enclosure of the rent. It's the way people behave. That's the cycle, right?
Phil, something doesn't seem to be right. We've got the stock market is going well. We've got the property market going great. Some places white hot. Gold is treading water. Bitcoin at the moment going nuts if you bought in the last 6 or 7 or 8 weeks.
Yeah.
Everything's going up.
Yes.
We're all going to die and go to heaven and be very happy.
Yeah.
What's going on?
What happens, Greg, if you get to heaven? You get to the gates of heaven and St. Peter there says, I'm sorry you can't come in at the moment because everybody's too busy speculating in the next piece of cloud. Yes? We'll get to that stage here. And when that happens, we're all full and nobody's got any money left to speculate even more. And we're all full to the brim with 100%, 125% credit. You know what's coming next. You see, the thing is, Greg, things are never what they seem, really. And as you go into the final 13th and 14th year of a real estate cycle, things look fantastic. They really do. Everybody's rich. You get people coming on TV shows, you'll get people coming on the Zoom calls, and you get other people saying how much money they've made. But what they don't tell you is all the credit that's been issued behind it. Banks don't tell you that they're lending more and more. You don't start to see those sort of figures. Yes, it just looks as though everybody's got a lot of money. Yes, and at that point, that's when the system is at its weakest. And you know it's at its weakest by the height, for example, one way to know, by the height of the tall buildings. I teach my subscribers, if people subscribe to my service, I show them what to look for And my specialty really, it just seems, people either are real estate people or stock market people. My specialty seems to be I'm in both. And I teach real estate people how to understand the stock market, because the stock market leads. You can determine what the real estate market is going to do next by understanding a chart and understanding stock markets. If you're in the stock market, you understand how the stock market behaves and how it peaks by knowing what the land market does, because it's rent that underpins stock market valuations in the finish, and the level of interest rates capitalising the rent. So if you know what to look for coming up, and there are, that you can know as we go into the peak, there are certain stocks will behave a certain way. I know what those stocks are to look at. I know where they are. And so if you can read a chart correctly, which I teach people to do, you can see, you'll be able to know what peaks first. You should know when. And when that happens, you know what's coming next. I hope that makes sense. That's what I show. My subscribers get it. They all understand it. They know what to look for.
Phil, given the certainty of your timing, why not buy property now and aim to sell just before the fall? Why don't you get out there and make a bit of a windfall right now?
Once I buy, I never sell. Why would you sell? I don't get it. Why you would sell? If you own property and it's well capitalized and well located, and it's all covered properly, and you're managing your risk and you're doing those other things, why would you want to sell? I don't, I'm not sure I understand that question completely. Well, Greg, I've got to say, I do understand the question. I'm just trying to say I don't sell, right? I buy, I rarely sell.
Okay,
unless I could find a better option. But Greg, there's no point trying to be a smart ass, right? I'm not saying you can time everything completely to 100%. I don't, apart from anything else, if you try to sell everything or sell property at the time, what the alleged peak is, you've got tax problems, and then of course, as the downturn proceeds, what you've got to remember is once the downturn takes place, it's very hard to get a loan, very hard to get credit. The first property I bought in London, which was in 2009, I couldn't get a loan. I paired up with a very good friend of mine. She actually worked for a bank. She couldn't get a loan either, and she worked for the bloody bank. Yes, banks won't give you land. Banks won't give you credit at the time when you really desperately need it. So I had the fatal sin really is I bought the first place in London with cash, right? That's where I lived. It was the place where I lived. That wasn't very helpful in trying to line up the third, fourth, and fifth properties, because eventually you run out of cash, as we all know. So then you've got to work out other strategies. So once things started to improve, you can get a mortgage on it, but you can never really take your cash back out. So until things recover greatly. So I don't want to suggest people be a smart ass and just sell at the peak, right? Just put yourself in a good situation.
We had Robert Kiyosaki on our show last month, and he said he said he's made $600 million in real estate, and he said, I don't make my money when I sell, I make my money when I buy.
Yeah, well, that's fair. So much I could say about that. The profit's in the buying. I think that's fair.
Martin North, I think you know Martin, don't you?
Yes, good fellow, Martin.
Yes, you and him do disagree on a few things.
Oh yeah, but it wouldn't be interesting if everybody agreed all the time. I hate sitting in a committee where everybody agrees. That's when you start getting things wrong.
Well, Martin believes we're in for a bit of a shake-up soon, okay?
Yeah.
And Martin is saying that he doesn't look at the cycles. What he's looking at, and I've just written it down here, he's saying that the mortgage pressure and salary to debt, salary to price ratios is all out of whack, and it'll bring the castle down. What do you say to that? You know Martin. You know that's his view.
Well, I think you'll be right eventually. Just watch the timing.
He thinks now.
The timing nobody's got. Greg, the timing I just found, when I first when I first viewed it, it was very difficult to believe. You know, when I read, the only reason I believed Fred's book back in 1991 was because he'd written it in 1983. It was all factual now, because the UK system, you know, with all it had, actually declined like he said it would. So watch the timing. It really is all about the timing. One of the things I can say about that, if people want to discover that for themselves, and I do this in my classes, and anybody's welcome to attend the classes. You just have to be a subscriber. Yeah, Fred's book is called The Power in the Land. Okay, it's a book you should read. Written in 1983. He wrote another one, Boom Bust, in 2005 that successfully called the 2007 downturn. Boom Bust was his latest one. Let's get back to the question. What was the question?
We're talking about Martin North, and he was saying that the pressure of the multiples of salary and debt is going to bring the whole world down. Well,
yes, that's right. I was going to say, if people want to understand it truly, I was very lucky to come across a market, an old market participant forecaster called W.D. Gann, G-A-N-N. Gann taught me in his old books, you know, he's long since dead, taught me in his books how to read a chart. Okay. And so at the moment, Martin North cannot be right because earnings are increasing, which is why stock markets around the world are going up. The Australian stock market, like it does every prior cycle, it has always broken into new all-time highs at the beginning or just near the second half of the cycle. It's done that again. When a stock market of a country breaks into all-time new highs, it means the earnings of the country is going up. Now, when the earnings of the country is going up, you can't get a downturn. And so we're now in all-time new highs in the Australian stock market, the All Ords in Australia. Almost always, not always, but mostly, the markets continue up for a while because they're broken into new highs. Yes. So banks are lending, they're creating lots of credit, they're making profits, they're paying record dividends. Our Australian miners, for heaven's sake, you know, they're paying record dividends, record profits. That makes it continues to make people wealthy because they take out the dividends, despite the fact that for a lot of the mining dividends go overseas, the overseas owners. But it's creating earnings, you know. So when that's happening, you're not going to get a downturn. It can't happen that way. We have to have a few years of that happening, and everybody has to be all in. You can see the statistics through the COVID stuff. It does appear around the world that the majority of people actually saved quite a bit, and that now we've got record amounts of cash sitting in people's balance sheets, or in people's bank accounts. Markets don't peak. Markets don't peak until we are all in. There's no cash left, and we've spent it all, and we're living off credit, and we are a long way from that at the moment. Right. I think, you know, you see that in the earnings, and you can prove this to yourself. You know, I urge people not to believe me. I urge people to do their own homework, and the best way you can do your homework is to learn how to read a chart. And you learn how to read a chart. You can subscribe to my service, and you can read W.D. Gann's books, G-A-N-N. And he shows you quite clearly, once you can read the charts, because the market's always looking 9 months ahead. Once you can read those charts, you can see pretty much what's coming next. And all of the very well, you know, the stocks like Hermes and others, you know, they're selling lots of bags. People are wealthy. People are spending with their feet. The downturn's just not going to come yet. It can't happen yet.
Look, we had Harry Dent, we had Robert Kiyosaki, we had Jim Rickards, and I'll add Jeremy Grantham in there as well.
I bet they all told you. I bet after you heard all those people, you felt like slitting your wrist. Is that right?
Yeah.
Yeah. It's not going to happen that way. All right. Be bullish when it's bullish time. All right. It's a fantastic time to be alive. The world, Greg, the world is full of abundance. It's everywhere. Yes. All you have to do is feel that you're worthy and get some of it for yourself. The universe wants to give it to you. It really does. All right. So just Stop listening to the shit that's going on with politicians and government. Put yourself in a good position where you can read a chart, understand the markets. You've read my book and you'll know what to do next. Heavens, it's not hard.
Phil, I'm going to carry on with this question. They're all saying we're heading for the Great Depression.
Yeah.
It's all over. Stop
No.
smiling.
No. It'll be, in my opinion, if the real estate cycle repeats like it does, 14 years up, 4 down. 14 years takes us to 2026. Actually, to December 2026, okay? Should be the peak. It'll be a depression after that. If you've bought at the wrong time and you have no cash left, you've thrown everything in, you haven't managed your risk properly, and you're all in at that time. But if you happen to even remotely understand how people behave and the indicators that you see around you in 2026. So if in 2026, the world's tallest building is being built, somehow we have this new invention that will allow us to go to Mars or to the moon quickly, and suddenly everybody wants to buy a piece of the moon, and we start advertising it. If we get somebody famous stands up and says real estate will never collapse, or if we get the Fed, if the Fed are in accommodative stance or whatever, right, or perhaps going into 2026 or so, we might see an inversion of the yield curve threatening. It might have happened already, and we see everybody's got lots of money. Yes, well, at that particular time, you don't want to be behaving like the crowd. No, you want to be doing the opposite. Prepare yourself for an impending decline of some sort. Yes, and if you do that, you'll be very well off. And you know what to do at that particular time by understanding history, and the history is all in my book. It's very clear.
Share market, it's booming. I have some people saying to me, the people I've been interviewing, it's going to crash and burn at any moment. I had another fellow, John Thomas. He sees it booming for another 10 years. So there's all sorts of views on the share market.
Yes.
What's Phil Anderson's view?
I just go back to my 14 years up, 4 down. Yes, and that 14 years up is split by a mid-cycle slowdown, which it's not that hard to work out when that might happen. I try not to get into worrying about what the stock market itself will or won't do. I try to read the charts. I do manage funds these days. I run a small fund run out of Adelaide. So I just try to watch what individual stocks are doing, and over the next couple of years, I think it's reasonably fair to say. Well, I know for sure. History says second half of the cycle, the best performing stocks are in the real estate sector and the banking sector, and usually infrastructure as well. I think that's playing out again. I just watch for stocks to get into certain positions that I look for. I like to see stocks make reasonable breakouts. There's plenty of stocks in Australia doing that at the moment. I just try to get on one. I don't worry about what the market itself might or might not do on its own. I think that tends to make you a bit fearful. So just try to learn to read a stock, work out certain charts that look interesting and get in on them. So, there's the real estate trusts in Australia. I think they'll continue to do well. Infrastructure stocks, not all, but those that have got a decent looking chart. The market tells you, if you learn to read a chart, the market tells you what stocks are likely to do next. And I try not to worry too much about the stock market itself. The stock market's looking itself overall, the US market, but not the Australian market. The US market, it's had a decent run up. After a decent run up, it normally, has some sort of minor correction, but it's just not going to collapse at the moment. It just isn't going to happen.
Phil, the elephant in the room, of course, is got to be COVID-19, because, you know, as I go, and I asked this question earlier to Mark Bouris, obviously we're seeing airlines have got parked airplanes, you've got hotels that have been, you know, sealed up, you've got shops and cafes and restaurants that are going out of business. I live in Crow's Nest, and there's so many restaurants going out of business. You know, is it going to get to a point where all of this scare tactics is going to drive us into some sort of challenge, if we like it or not?
That's a good question. I don't have the answers to those questions. Clearly, COVID and the situation at the moment, which, again, in my view, governments around the world have made worse than it needed to be. But having said that, the fact is a fact, how it's presented. And, you know, if you're in the, you know, I got several mates that have been decimated. One of them runs a great, nice little motel in Melbourne. Utterly devastated. I mean, it's ruined his life completely. So, you know, I understand certain sectors, it's been very, very difficult. Airlines, travel, those sorts of things. Having said that, you know, the mid-cycle, the halfway point of the real estate cycle, it's always fairly similar. It does play out along those lines. There are always one or two sectors that end up doing really badly. You know, I don't ever try to forecast what that is. I just know there's a downturn coming for mid-cycle. We've had it. We now have to recover. If I was to make a forecast about that, my suggestion would be that soon, probably in about 3 or 4 months, the governments in Australia, the state and federal governments, they're going to have to say to themselves, what they've done hasn't worked. They're going to have to make some sort of modifications. And I think they'll end up adopting what Singapore have just come out and said, is that COVID is a flu. It's more serious than some others. It's more contagious but less deadly than many other illnesses. We're just going to have to face the fact. We're going to have to live with it. We're going to have to stop listening to the emotional scientists all getting onto the front pages and loving it, and simply say, this is what we live with. We have to get used to it. You know, and I think Singapore's come out and suddenly realised that. You know, the statistics will come out eventually, I think. And I think eventually we'll get to see it, but governments may try to cover it up, especially in Australia. In Singapore, the last 12 months, they've had, I think it's about 1/5 less deaths than what they would normally get in a year of people dying from the normal influenza. So they've put themselves into a complete lockdown, simply to go below normal in the amount of people that would have died anyway. Now, don't get me wrong, I'm not trying to appear harsh when I say that. Every death is tragic, obviously. You know, and I know one or two myself, and it's difficult. But sometimes we have to manage risk. We have to live with risk. Just living life is a risk, you know, crossing the roads and doing all sorts of other things on an individual basis. It can be tough. So I suspect within a few months, some sort of realistic attitude is going to have to set in. And I think we'll just get back to normal pretty much, and things will just start livening up. And when that happens, there'll be a lot of people that want to get out and celebrate, start spending their money.
Phil, our hour's just about up, but I just want you again to tell us, and by the way, you're a very informative person. You're a very interesting gentleman to talk to. And
yeah, thanks, Greg.
Your insight is spectacular. And I think everybody needs to hear what you have to say, to see another side. And I think it's wonderful, wonderful. I think everybody watching this at the moment would be agreeing with me. Absolutely. Now, Phil, one more time. The book, your book, give me the title again. Also, The Secret Life
of Real Estate and Banking. Yes. Read that, and you too can be a great historian and start to understand the system. It's not a hard book to read. It's quite simple.
Okay, everybody, write that down. Now, Fred's book.
Yes, I think you've got to read Fred's books are a little bit harder. They're more academic. 2 books, The Power in the Land, and his more recent book, 2005, called Boom Bust. They'll give you a good perspective on history. I think it's important to have that perspective.
Yeah, yeah. Now, Phil, how do people subscribe to you? How do they hook into Phil Anderson? I know, tell everybody, do this.
Yes, just go to the blog page on propertysharemarketeconomics.com. Okay, it's at the website, propertysharemarketeconomics.com. Just have a look at the blog or a sign up page, and you can go from there.
Wonderful. I know that we've only just scratched the surface with Phil Anderson.
Yeah, we have. Yeah, there's a lot more in it.
And, you know, we've been going full on for an hour, and thank goodness we didn't go down that COVID-19 track too deeply with you. That we may never have come back. But that's another one. Phil, we'll have to have you back again. You're too smart. You're one of the sharpest tools in the shed, and whatever. I just want to say thank you for giving up your time this morning. You got up very early this morning. I know that, probably about 5 o'clock a.m. To be on this. And so we really, really enjoy it. And I'm seeing all the comments coming in. They're saying you're awesome. You're fantastic. One of the best interviews I've ever heard. These are people putting it in the chat boxes. You're not seeing it. I'm seeing it. And I know they're right. They're saying the best ever. Well done. And so thank you so much, Phil. To get that many accolades is just amazing.
Yeah. Thanks,
I haven't had them say that to the Kiyosakis, and I haven't had it said it to the Jim Rickards, but they said it to you. It's amazing.
Yeah. Well, let's keep things a bit quiet, shall we, with some of the information, so that the people listening there, we can all take advantage of it as we go further into the cycle. We don't want everybody to know, right? We just want enough people to know, so we've got other people that we can take the other side of the trade, right? Okay.
Good on you. All right. I want to keep the program on time. You better go and have breakfast. Thank you, Phil.
Right. Thanks, Greg.
Mark Bouris needs no introduction, I can tell you. You know, he has an Order of the Australian Awards in AM. He started Wizard Home Loans. His business partner was Kerry Packer, not a bad business partner. He then went on to create Yellow Brick Road. He's been the host of the television series. I know we all know Mark Bouris, but I just thought I'd throw it in. I know he's a mad, crazy Roosters supporter. I met him at the SCG some months back, and there he was. We're up at the top level of the members area. He's sitting next to who else? Nick Politis, the guy who was Mr. Fix-It, Mr. Big of the Roosters. So he mixes with the right people. But at any rate, saying that,
ready to go.
Over to you, Mark.
Thanks, Greg. Right, we're here to talk about property prices in Australia, or property market in Australia. And I'm talking about residential here, of course. I'm going to talk about commercial property. It's a different beast. Generally speaking, I've got 30 minutes to do this. So generally speaking, the way I assess any asset class, and by the way, let's look at property in the beginning as an asset class. So let's look at it completely logically without any emotion. Then I'll apply a little bit of emotion at the end. But because that's the Australian population looks at real estate in Australia, residential real estate, with emotion as well as facts and figures. But so let's look at it completely from a unemotional, logical point of view. The way I do that is the first thing I do is I look at the macro position, what I refer to as the macroeconomics of Australia as a place. And I should say to you that, I'm doing this without the benefit of having had any discussions with many people on this, because, we're in a sort of an unusually evolving economic period in this country at the moment because of all the interventions, health interventions. But interestingly enough, I'm actually interviewing the treasurer, the federal treasurer, on Friday, and I'll be putting that up as a straight talk on my own platforms, hopefully the end of next week. I wish I had been able to interview him this week, but I couldn't. I tried to get to him, but I want to get some insights from him, which I'd like to share with you. But anyway, that'll happen next week. But the macro position is as follows, and I'm getting my information out of two main sources. It's the Australian Bureau of Statistics, probably three main sources. It's the Australian Bureau of Statistics, the Reserve Bank quarterly reports, and finally the NHFIC, which is I think it stands for the National Housing Finance Investment Corporation, which is an entity anyway that actually builds very good information and data on residential prices in Australia, both supply and demand side. So let's look at the macro position. So importantly, you know, it's about the wealth effect. I mean, how wealthy do I feel as a buyer and as a vendor will depend on whether or not I choose to upgrade my home, buy a new home, enter into the market for the first time, and or buy an investment property to add to my portfolio. So the macro position is really important, and GDP is an important one. So gross domestic product. Let's not even look at how this is actually calculated. It's irrelevant. But what's important here is this. In the general run of gross domestic product growth, that is the addition of all indicators in Australia, which include government spending, private investment spending, in other words, you know, money that businesses will spend on investment, both in mining and non-mining, the consumer spending, what we refer to as domestic spending, the money people spend on houses, on rent, on shoes and communications and all those sorts of things, cars, etc. All those things, all those consumables, plus the difference between what we export and what we import. So that gives us a thing called gross domestic product, which is a measure of how productive the country is from year to year. And the long run growth of that number, we're about $1.4 trillion annually. The growth of that has been an important indicator for governments. Governments use it to build their budgets. Normally, we work on an assumption in normal periods. We work on an assumption of about 3.1, 3.2% growth per annum. But our long run growth rate has been disappointing. It's been about 1.95 to about 2.2 over the last few years, up to 2000 and including 2019, where it was 1.95%. But in 2020, it fell for the first time to by minus 2.5. So around 2.5% it fell, which is the first time we've had negative growth for 2 quarters in GDP for something like 30 years. Australia had the longest long-term growth numbers ever in any country's history up until last year. And I still say we probably are still in that category. But we fell in 2020 by 2.44%. That was the actual number, which makes sense. We had, suffering like everybody else from the COVID effects. 2021 to June 2021, we grew at 4.54%. Now, there's a number of reasons around that, but we come off a very low base. And most people would have experienced the growth in Australia in the first half of this calendar year. And that gave us a false growth number of 4.5%. When I say false, it is off a very low base. And so 4.5%, if you could somehow calculate, and it's very difficult to, if I could, somehow calculate that, it would be getting back closer to our 2019 long-term and our long-term growth numbers of about 1.9, 1.8% per annum. But we did grow from 2020 to 2021 at 4.5%. Now, how is that tracking at the moment? No one knows. We won't know that until the end of January, when the next lot of numbers, 6 monthly numbers come out. But clearly the expectations in the marketplace at the moment is GDP will grow slowly for the next 6 months. And for obvious reasons, a lot of interventions with lockdowns, et cetera, have hit us. That's the first one, GDP growth. So generally speaking though, in a normalized market, when I'm looking at residential house prices, I'm looking at the wealth effect. How wealthy do we feel? GDP is one of the indicators, an important indicator. I think GDP, once the lockdowns finish and once vaccinations are up to the numbers that we're talking about, and making the assumption there's no, new variant that, the vaccinations they work on, I would say we're going to get back to the wealth effect sometime next year, similar to where we were at the beginning of this calendar year. The next indicator is inflation. Inflation is a really important one. Inflation right now is running right now is running at 3.8%. Now, why is inflation important? Inflation is an important indicator to the Reserve Bank. The Reserve Bank looks at inflation to range between 2 and 3%. If it goes above 3%, it looks like it's going to be like that in the long term or medium to long term. Above 3%, the Reserve Bank starts putting interest rates up. And interest rate increases are obviously an important factor when it comes to house prices. So it's currently running at 3.8%. Well, but that again, it's not a fair figure, not a proper figure. So to be frank with you, there have been a number of silly increases over the last 6 months in Australia. Fuel increased by 6.5%, contributed to that 3.8% growth. Health increased by 2.4% over the 6 month period, contributed to that 3.8%. Electricity increased for a whole lot of reasons, but one of the main reasons is that the West Australian government dropped their $600 rebate they used to give to West Australians for electricity prices. That actually falsely pushed up the electricity price increase to 3.8%. Food and beef, food generally, and particularly beef prices have increased tremendously by about 5.5%. And that's largely off the back of the droughts. It's largely off the back of the bushfires when it comes to beef. And we have a low beef stocks in Australia. So beef producers, I'm one of them. We have not sold our stock for a long time. We're trying to rebuild our herds. So, recently I went and bought beef at a cattle sale, and I was buying cows, and I was paying $6.50 a kilo. 3 years ago, I was paying $3.50 a kilo. So, 200 kilo animal was going to cost me around $1,300, and whereas I was buying those for nearly half the price 3 years ago, and that's because we're all trying to rebuild our herds. So beef prices are up. And motor vehicles are up. Motor vehicles have gone up. Even secondhand car prices have gone up because of the COVID environment. So what I'm trying to say to you is that 3.8% inflation number is not a number that we should be looking at as a long-term number. It doesn't worry the Reserve Bank. The Reserve Bank is stripping out a whole lot of stuff out of the 3.8%. They are comfortable where inflation actually is, real terms actually is, and have no feeling like they need to increase the interest rate to account for inflation growth. Wage growth in Australia, as another indicator under the macro position, wage growth is virtually nil. We haven't had wage increases other than in the public service sector, particularly in Victoria, for a long, long time. So wage growth is not something that will concern anybody in terms of increasing interest rates. And wage growth is not something that's making us feel particularly rich at the moment. Fiscal policy is what the government does, the federal government does, and the state governments do to enhance asset classes. So we did have last year some very aggressive fiscal policy from the federal government. There are a number of grants being thrown around the place for first homeowners. There was a $25,000 grant for people who wanted to improve their property when they spent more than $150,000 on their property. Each of the states has first homeowner grants. New South Wales has a $10,000 grant. It's subject to a number of conditions, but nonetheless, so these are there to entice people to buy property, first homeowners in particular. The federal government grants have all backed off now. They all backed off around December last year. They were put in place just to keep the construction industry going. But nonetheless, fiscal policy is something that federal governments and state governments are very happy to use to promote the construction industry in Australia. And we know, our governments know, the construction is has a very important multiplier effect. And I can assure you that I know that the governments will 100% use this as a lever if they need to further stimulate the economy through property. Health is another macro position matter we need to consider. Clearly, you all understand the macro position of health more than just as much as anyone does, so I'm not going to add to that. Population growth is really important. The more people who come to the country, the more people are born in the country, the more people who become 18 or 19 or 20 or become eligible to borrow money or get into that eligible class to buy property, the more demand we're going to have. So population growth in Australia, long-term average is from 2019, it was around 1.6% off a 25 million number of population. In 2021, it's dropped back down to it has dropped down to 0.1%. So that's a significant drop. And they're projecting for 2022 to be about 0.2% compared to, say, 1.6% in 2019. Now, that is an important thing. That's very, very important. And the main reason for that population downturn, the biggest reason for population downturn is the lack of immigration to Australia because we've closed our borders. So, and the question then comes down to, when do we open our borders? How does that affect? Why do we need to open our borders? Well, we need to bring people, mature age people and or skilled people into Australia to fill jobs. I mean, like, for example, one of the reasons why food prices have gone up in the bush is because they can't get pickers. Someone who would largely come from overseas, we can't get pickers to come and pick our whatever it is, grapes or whatever it is. And therefore we have to pay more money to local people because they demand a higher wage because they know they can, because they know there's less competition. But also, it also means when we can't get pickers, a lot of times they just burn their crops. They cut it down, they burn it. So therefore there's less stuff available for sale. Therefore the price goes up because the demand remains the same. So population growth is a really important number from a macro position in terms of how we feel about our economy, and population growth is going down. By the way, in 2020, natural population growth, that is through people getting, people having children also went down during the COVID period because there was general concern about health, etc. So that's starting to pick up in 2021. I don't know what the effect of it will be in this current 6 months because COVID has actually come back. The Delta variant's come back and maybe has scared a few people from having kids at the moment, which that won't reflect until sometime next year. But population growth is down, and that's a very important number to remember. Now, the final one is supply of property in Australia. From a macro point of view, this is really important. There are two really important constraints that apply in Australia that don't really necessarily apply in most other countries in the world. We have geographical constraints because 60% of Australia's population sits in 3 cities, Sydney, Melbourne, Brisbane. That's a very unusual situation compared to most places in the world. And the reason for that is because largely because of our geography. And the fact is that, we have a lot of deserts and areas which would require a hell of a lot of new infrastructure to allow the population to sprawl beyond the 3 major cities. And as a result of that, population or demand, I should say, is quite high in those 3 major cities relative to the supply. That's one. 2, we have planning constraints. We have this thing called NIMBYism in this country, which means not in my backyard. Generally speaking, everyone's got a say when it comes to the local councils. Local councils, as opposed to Queensland, but certainly in Melbourne and Sydney, local councils, they've voted in. The local people don't want any developments in their area. So whilst we need greater density in our 3 major capital cities, we're not getting major density because the planning approvals just take so long. So there's a massive lead time between someone buying 10 houses with the appropriate planning constraints, putting an application in to get those 10 houses turned into one property so they can put a block of apartments, for example, on there. The period is like somewhere between 3 and 5 years, which is quite long. So we have planning constraints in this country just due to the politics that apply. So we do have supply constraints. But I will say this to you. We have had, and you'll see if you go to the NHFIC report, which is a property report that's prepared for Australia, NHFIC, you'll see that we are probably a bit undersupplied when it comes to apartments now, and we are oversupplied when it comes to single dwellings or separate dwellings now relative to where we were, say, a year ago. And largely those separate dwellings have come off the back of all the various government incentives that have been around for the last 6-7 months, or for the first 6-7 months of the 2021 financial year as a result of the COVID situation. So we have an oversupply of around 83,000 homes, which will probably take us through to 2023, 2024, relative to the population growth I'm talking about. But that depends on whether or not the borders open up. And if the borders open up, then that number will disappear very quickly. So there is a little bit of a balance when it comes to supply of property right now, single dwellings of property right now, particularly here in New South Wales, so and in Victoria. So that's an interesting one. So when it comes to the macro position, these are things you can all follow yourself: GDP growth, inflation, wage growth, fiscal policy, the health of the country, population growth, and geographic planning. And if you're looking for real numbers, go to the NHFIC. So they're the indicators I would be looking at on every occasion for the macro position. But the second position I look at is, what are the actual economic indicators? What are the things I look to for economic indicators? Now, for many years, and some time ago on one of Greg's shows, I did a debate. I did a debate in Melbourne. I did a debate in Luna Park. We had, I think, 900 and 1,000 people respectively. I debated a guy called Harry Dent. Harry Dent has been running a program saying that Australian property prices, residential property prices, are going to fall, and they are stupidly high relative to the rest of the world based on various indicators. He used to get his data out of The Economist. The Economist is a well-known magazine. It used to write its a column, and often used to write about Australian property prices. And they used to use a very important indicator that was prepared by a group called Demographia, I should say, and that is what they call the price to income ratio. And they used to also talk about what they call the debt to income ratio. Now, these are 2 ratios you apply to any asset class in any environment that you want to refer to in the world. It can be share prices, it can be whatever, gold prices, etc. But in the case of property prices, that's just another asset class. The debt to income ratio and the price to income ratio for Australia relative to the rest of the world were very, very high. So the current debt to income ratio in Australia is around 200%. That basically means the average debt of Australians, and that's all debt, relative to the average income of Australians is double. So if the average debt of all Australians is $200, then the average income of all Australians is $100. They're not the actual numbers because the average Australian income is around $63,000. So therefore the average debt is about $120,000. But that includes all debt. That includes mortgages, debt for investments, and just personal loans for cars and depreciable items. What's interesting about that is that debt to income ratio for Australia is, I actually don't think it's a very good indicator, but nonetheless, it is an indicator. And we have had very high debt to income ratios for 20 years. If you go back 10 years ago when I had the debate with Harry Dent, it was 160% as opposed to today of 200%. At 160%, it was considered extraordinarily high relative to the rest of the world. And it's relative to the rest of the world. But we also, if you have a look at our defaults, because it can be an indicator of where if Australians are going to start to default. If you look at our default ratio, we have the lowest default ratio when it comes to mortgages in the world, bar none. And we still have, and we have had for 20 years, and we still have to this very moment. If you look at how that debt to income ratio is made up relative to other countries, 92% of the debt of Australian debt is either for mortgages, so increasing asset class, people buy property with that mortgage, which has meant that people are investing money, or just general investments. People borrow money to make general investments. 92%. Compared to the rest of the world, the closest to us of any other country, the developed country in the world, is 75% of the debt. When they do the debt to income ratio, 75% of that is applied to investment and or housing, and 25% is just applied to stupid things like, how to pay my school fees or something like that. So Australia's debt to income ratio makeup is in asset classes that are increasing people's wealth. That's one. That's a very important indicator, really important. And there is nothing to show that our debts in Australia are defaulting at a greater rate than they ever have in the past, notwithstanding that we've increased to 200%. And if I look at 200%, that means we've had a 25% increase in our debt to income ratio. In other words, we have 25% more debt relative to what we had, say, 10 years ago. But if I look at the interest rates today relative to 10 years ago, our interest rates have decreased by 40%. So we are servicing a 25% greater amount of debt to income in this country relative to 10 years ago, but we are doing it at a rate of 50% lower. So the amount of money it costs us to service that 25% is 50% less. So that's a very interesting stat. I haven't actually calculated that out, but I can tell you now, we are actually in a better position today than we were 10 years ago. And if you look at our defaults are no worse than they were 10 years ago, and indeed no worse than they were 20 years ago. So I think the debt to income ratio is not an indicator that we should be worried about. The other one is the price to income ratio. Now, the price to income ratio means the price of an asset class relative to the income that buys that asset class. So, and they say if it's above 7, you're starting to get scary. In other words, if the average income of prices of property in Sydney is $100,000, but the average price of properties in Sydney is $750,000, then that's a problem because it's too high. That sweet spot is somewhere between 5 and 6%. If you care to find out who's done the proper analysis of this, the Reserve Bank of Australia does it every 6 months, and they do it in February, and they release it again sometime October. They do a price to income ratio of housing in Australia. So they don't do it based on averages, which is what Harry used to do. He used to base on averages, which is what the economists used to do, to base on averages to build a good story. It's not about averages. Lenders don't lend to the average income borrower, the average income person. We lend to people in slightly above that. So if you do it properly, the only place you'll see where it's done properly is the Reserve Bank. The Reserve Bank's been showing it sitting between 6.5% and 7%. That's right in the sweet spot. So And they monitor this more than anyone else in the world. They monitor it more accurately, I should say, more than anyone else in the world. So when the next Reserve Bank report gets put out, they put one out in February this year, it shows us we're in the sweet spot. So that indicator is okay too. So I would say to you that don't be conned by the debt to income ratios, the price to income ratios that the so-called scary tactics are trying to promote around the world relative to Australian property, because right now the Reserve Bank's done the analysis and says it's okay. Now let's look at affordability, because the final one is affordability. In other words, how much can I borrow? How much does it cost me? Is there slack credit in Australia? In other words, are there lenders out there lending money with the ears pinned back as if they don't give a shit? That is not the case. We are so heavily regulated in this country as a lender. I own a company called Yellow Brick Road. Yellow Brick Road is we're the third largest aggregator in the country. We lend, between $2.5 and $3 billion a month. And we have been doing that for 10 years now. And prior to that, I was at Wizard as well. So I've got a pretty good understanding, a pretty good indication of how credit works. It is harder to lend money today than it was 10 years ago. It's harder to lend money today than it was 5 years ago. The regulator is all over us. As a result of the Hayne Royal Commission, the amount of hoops we have to put borrowers through, it's tougher to get credit approved today than it ever has been in the past. We are more analytical and we do more analytics into people's borrowing. So I can't say to you that I think that the credit system is weak in Australia. Therefore, we are not lending money to people on any property and doing whatever they want to do. And indeed, if you go back to the GFC, Australia did not suffer from the GFC. We were not a subprime culture. We're not even a near prime culture. We are a prime culture, and we always have been. That's why Australia got through the GFC so well. There were other factors, but generally speaking, we weren't bad debt affected, because our regulators are pretty tough on lenders in this country. And then you got the Hayne Royal Commission's made it even they're even tougher on lenders today. So we are the affordability is not off the back of weak credit or poor credit policies. Affordability today, in other words, the amount of money that's been lent into the system. And by the way, lending has increased. We have lent more money in the system in the last 3 months than we have prior to that, and for a long, long time. And the lenders market, the lending market is actually growing. We are lending more and more money every quarter. And that's not off the back of poor credit. That's off the back of good credit. And that is a result of people having more savings, having more equity, having controlled their expenditure much better than they've had in the past, and therefore having more net income that's disposable, which we can assess as in their ability to service the debt. So I can say to you that when it comes to affordability, that is the amount you pay per month. And that is a function of the amount you borrow and the amount of interest you have to pay over a 30-year period. We have never been in a more affordable state in Australia for property acquisitions than ever before. A property, therefore, is more affordable. I'm not saying the price of property is lowest, but the amount of money you need to borrow and the interest rate that applies to that amount of money which calculates how much you have to pay per month. Affordability is how much I have to pay per month, not the purchase price. Affordability in the mind of a consumer is what do I have to pay per month? They're not thinking, oh, this is going to cost 500,000. That's too much money for it. No, because they're going to borrow 450. They're thinking, how much money does it cost me per month? So affordability drives house prices, or more importantly, drives demand for house prices. So that's really important. And affordability has never been better in this country. It was a bit better about a month ago because we had these amazing fixed rates below sub 2%. That came off the back of the government putting out a whole lot of money to the big banks to lend at sub 2%. That money's been withdrawn. That's not available. They got withdrawn late June. But nonetheless, there is brilliant variable rates of 2.4, 2.5%. There's still some very good fixed rates out there. So affordability in this country is very good, and it's not because of slack credit rules. I want to say to you, as well as this, there's some very important structural changes that have occurred in Australia. Very, very important structural changes. And this is something that property buyers got to become aware of. And the structural change is backed up by the analytics, by the evidence. If you look at New South Wales stats and Victorian stats and Brisbane stats, being the three major cities, and I apologise for not covering Perth and Adelaide, but I haven't looked at those. But if you just look at the three major cities, there has been net migration. So when you talk about population growth grows demand. If you've got net migration out of major cities being Sydney and Melbourne, which we have had net migration, where is the net migration going to? Well, it's actually going to Brisbane. Brisbane Metro has had net migration out of both Sydney and Melbourne. And that could be people chasing jobs, it could be people chasing, better health systems, perhaps, less worry about COVID, it could be chasing weather, it could be chasing cheaper house prices, more affordable stuff. etc. Who I don't know what the reason is, and I don't think there's been any analysis to say what the reasons are, but nonetheless, that is a stat. Net migration out of Sydney and net migration out of Melbourne in terms of population growth into Brisbane. Then if you look at Sydney and Melbourne, or if I can just talk about Sydney for a second, because I'm running short on my first half hour before the Q&A. Sydney has had net migration out of Sydney into regions as well. Now, there is a phenomenon, the digital economy phenomenon is showing people that they can operate from home. So COVID has actually fast forwarded this. And therefore people are saying, well, if I can actually operate from home, therefore I can have my home anywhere. So there has been a very big increase in migration out of Sydney into the regions. Places like Orange, Ballina, places down the south coast, people into Lismore, etc. At Coffs Harbour, places with airports, with schools, with hospitals, with infrastructure and amenities, close proximity, to the north of New South Wales where it's warmer, and also to cheaper prices. So when you get that net migration, people will, if they've got a property here in Sydney, they'll sell down and they will buy something else, which means they can afford to pay more money relative to what they sold here to what they're going to buy into the region. So there has been that structural change, a structural thinking has created a regional change in property prices, and property prices in the regions are actually galloping at a very, very fast pace. And that is off the back of structural change that exists in our country today. Overlay that with all the other macro stuff I said, and overlay with that the fact that affordability applies, and overlay with the fact that lenders want to lend money, and that people are usually buying cheaper houses relative to what they sold. You can sort of see that it's going to push prices up in those environments at a faster rate than ordinarily would happen. So if you're in the residential market, start to think about, if there's been net migration out of Sydney, but not population growth generally in Australia, but there is population growth therefore in a region, but because of net migration, well, population growth still will drive prices. So you've got to see, and who is that population? And we're not talking about unskilled people. We're talking about skilled people with good jobs, 3-4 years worth of income that they can show, tax returns showing good income, sometimes really good equity that they can put into a property, sell down of one property to buy another property. We're not just talking about retirees or people retiring to the country. We're talking about young people, young families who are moving up for cleaner, healthier, cheaper, more efficient, less mortgage type of lifestyles. Bang. That structural change is something you've got to keep your eye on. So I think that they're the main things I wanted to talk about. I wanted to talk about the macro position, the indicators, as I said, the indicators, economic indicators, which all help Australia in terms of residential pricing generally. Affordability is very much in our favour at the moment, and the Reserve Bank's made it pretty clear they won't be putting interest rates up for the next 3 years. They made it pretty clear. They just make it over and over and over again. And finally, structural change. Now, they're the hardline logical things, and of course, let's just overlay that with one last thing. Australians love property. We, as an asset class, we have an emotional attachment to property. And Australia, the laws around Australia are that we'll do whatever we can to protect our property first and foremost. We'll get a second job to pay the mortgage, because we never want to be seen as doing something that is a failure when it comes to our residential property. So because the consequences are dire in this country compared to, say, the US, where you just hand the keys back and it's all right. So we have this emotional connection with property in Australia, and that emotion sometimes in good times, particularly in good times, will drive owner-occupier buyers to pay prices which are, generally speaking, higher than they would ordinarily pay if they're investors. And I want to give you one last indicator. There has been an increase in the investor market in the last 3 months. So generally speaking, investor markets are around about 10% of our volume. We're seeing it around about 15% at the moment. So there is, because investors are starting to think we're getting to a point where we might be able to start to get more rents out of our residential investment properties. So there is a bit of a push, a slight increase in investor appetite or investor borrowings to buy investor properties to rent out to people. So I think I had to rush through, because I could talk about this for hours, but they're the main things. They're the main 5 things, fifth one being the emotional attachment, but macro positions, economic indicators, affordability, structural change, and then finally the emotional attachment we have to residential real estate in Australia. So I think I'm going to go back to Greg and do some Q&A. Thanks, Greg.
Thank you, Mark. I'm pressing buttons everywhere. Can you hear me okay?
I can, sure can, yeah.
Thanks, mate. That was so passionate. I love it. Fantastic. You could talk on this subject all day and all night, can't you?
I can, yes.
But isn't there a danger here now? You talked about Australia having a great love affair with property, and like you and I are similar ages, and I know that that's been the case since we were both 16 years of age. We all talked about buying that property and the passion behind it. And you're right. People would do whatever they have to do to keep their property. It's a great attitude in Australia. And that's why we don't have the jingle envelopes that they have in America, because they were prepared to have a psyche to walk away from it, but not in Australia. We're tough. We're tough about our property. But one thing that you did say that was a bit of a challenge is that more and more people now are getting into the investment property market. Now, surely this could be a little bit of a catalyst to create a challenge, because all of a sudden people are doing things they didn't normally do. This is not the family home. This is an investment property. And could this be putting more pressure than should be on everything that could bring the castle down?
Well, there will be less emotion attached to the investment property for sure, because it's not where we all live. It's not owner occupier. So therefore there could be a greater propensity to put that property in the market if something doesn't work out. I agree. But it doesn't, that might be I guess, as a percentage of the total amount of owner occupier versus investor properties, generally speaking, it's somewhere between, growth is around about 10% of the total portfolio annually. So as a percentage of the total, it's not that big. Unless if everybody in the investor market put their properties on the market for sale, that would be a problem. But Australia has some unbelievably favourable tax concessions, which no one else in the world has. Favourable tax concessions for people who own investment properties. For example, negative gearing is a good example. And that's unlikely to be removed by this current government. And I don't think the Labor Party is ever going to bring that one up again, because they lost the last election off the back of that. And also the capital gains environment is that if you sell the investment property, if you're looking to sell something, you might sell something else before you sell your investment property, because of the favourable capital gains treatment in that only 50% of that's taxed. But the only time, therefore, you would decide to dump an investment property, therefore increase supply of investment properties into the marketplace. And bear in mind too, Greg, most investment properties are apartments. So the only time you would do that, make that final decision, is if you felt as though you are under so much stress because your tenant can't pay you rent, and it could be a COVID tenant, or it could be a tenant during the COVID period, and that you couldn't afford to meet your mortgage obligations because the balance of your salary didn't cover the difference in cost. In which case you would dump the property onto the marketplace. That probably applies to a very small percent of that 10% that I talked about. So yes, there is a danger of that happening, but the net effect of, I can't calculate the net effect, but he's sitting here, but I would say the net effect of it would be temporary, would be short, because there's always going to be a buyer if you put it at a price. So it'd be temporary. So someone will come in and pick those properties up. At a lower price, obviously, which would create a small loss or a loss of the equity for the particular individual who sold. But I don't think the property would stay there for too long. And also there are less new developments of apartment buildings in Australia at the moment due to a number of factors. The main one is that banks don't want to lend to developers at the moment for residential properties. I mean, I'm not saying there's no big properties going up, but there has been a reduction in the supply of those apartments. There are a number of factors, like just a stack of factors, but one of which is that banks are reticent to lend as much as they used to lend to property developers. So as we see the number of apartments available to be purchased, new apartments available to be purchased, drop off, and that may well get replaced by people who already own an apartment want to put it back on the market. So my gut feeling is it's not an external factor that will create a major hole in the investment property market in Australia. And if it does, it'll be a short term and or a temporary thing whilst buyers come back in, and people love a residential property bargain. And if you think we love bargains in Australia, one thing we love is if there's something going to get sold for a low price in residential property. I'm a buyer for a start.
Okay, good. Martin North. I don't know if you know Martin.
Yeah,
North.
I know Martin. Yep.
Oh, great. You know, Martin, you know, he's been on, look, we've had him on our show a few times, but, you know, he's been on 60 Minutes many times in A Current Affair. But of course, he believes that it's the mortgage pressure, the salary to debt ratio, the salary to price ratio, and any movement in interest rates going up, it's going to bring the whole thing down.
100% right. So, and that's what I tried to cover off. So right now, the salary to debt ratio, or the price to salary ratio, the two ratios, they're the two indicators that economic indicators you've got to look at, they are in the sweet spot. So, but the debt to income ratio is 200%, as I said earlier. The question then, but where that becomes a problem is if interest rates go up. And who puts interest rates up? Well, there's only two people put interest rates up. That's the banks, if they're trying to grab more margin, or if the cost of funds increase. And the only reason cost of funds increase is if the Reserve Bank puts interest rates up. The Reserve Bank's main mandate is the prosperity and welfare of all Australians, the economic prosperity and welfare of all Australians. That's what's written into the charter. If the Reserve Bank Reserve Bank knows what the debt to income ratio is, and the Reserve Bank knows what the income to price ratio is, because as I said, they put this out every 6 months in the financial stability report. This is one of the major things they look at, and they're saying they're not worried about it. They're not going to create, they themselves are not going to increase the cost of funds so that the banks have to charge us a ridiculously greater interest rate. In which case, what all that'll do is exactly what Martin's worried about, what you're talking about, would create defaults, because our debt to income ratios are so high and our price to income ratio is high too. What it would do is it will create a huge amount of pressure on the property owner market, and that would create a crash. So the Reserve Bank's got the hand on the lever. They're not likely to do that, otherwise it's going to cause a major problem themselves. And if they did, it might be one interest rate increase, just to bring us back a little bit. It's not likely to take us from 2.3% current variable rate to, say, 4% variable rate. And that's where it starts to kick in. It starts to bite in at around about 3.7%. And the reason I know this, Greg, is because the regulator makes us, the lenders, assess you, a borrower, not at the current variable rate. We have to add what they call a threshold. And the threshold is around 1.5%. So if my current lending rate is 2.4%, me and everybody has to lend, I have to add, when I assess you, add 1.5% to it. And I have to assess you at nearly 3.9%, which say 4%. And I have to say that in granting you the loan, your ability to service my debt is based on a 4% interest rate. And the regulator makes us do that to build in this to make sure that when we lend, that there is a sensitivity analysis done. So North is right. He's 100% right. You know, those guys are right. You're right. But the regulator knows this shit already, and so does the Reserve Bank. The Reserve Bank is assessing this every 6 months. The Reserve Bank doesn't just assess it on the day, every 6 months. It's assessing it the whole year. The first person they go and run to, if they think this is getting out of control, is they run to the regulator. They say to the regulator, hey, just to start, there's a problem here, because the last thing the regulator wants is bad debts sitting on the bank's balance sheets, because that actually, what that does is that compromises the banking system. And the regulator's interested in having a good banking system. Australia's banking system is the best in the world. We did not get affected during the GFC because the regulator was so tough on everybody, and the banks have enough capital. And so I haven't seen anything from the regulator to the banking industry saying that we have to now put more capital up in case there's a problem with defaults on our major asset class, that's mortgages. That has not occurred. And the regulator is assessing this daily, literally daily. It's one of the things that worries them most. And the RBA is assessing it as well. So I think that Martin is correct in theory. If there was an increase in interest rates, and the only way it's going to happen is if the Reserve Bank puts rates up. If there was an increase in interest rates to a certain level, probably to at least another 1.5%, well, let's say 1%. That's 4 interest rate increases. That would the Reserve Bank's not going to do it, because after the first or second one, they're going to go, whoa, the economy's pulled up, let's stop. You know what I mean? That's the practicality of it. So I think while Martin's correct in theory, and there is a sensitivity there, I don't see any shock occurring, economic shock occurring, because our regulators just aren't going to allow that to happen.
How long do you think, I'm putting the pressure on you here, how long do you think this low interest rate is going to happen throughout the world? Is it here for the next 5 years? If it's here for the next 10 years? That's a tough question.
Yeah, it's a good. I don't want to comment other than what I've read about the US, but the US Federal Reserve has been saying that they're quite comfortable with the increase of inflation, such that they don't feel the compulsion to increase interest rates in the US. Although the general view across the US, which is why the US dollar has been increasing against all currencies, including our own, which everybody can see, we're down at 71.5 or something. From we were 74 like 5 months ago, and that's because people have the view that the US is going, or that the analysts have the view that the US is going to be forced to increase interest rates in the United States, which is, bear in mind, they are at a very low official level too, similar to ourselves. Whether or not that will parlay, just because they increase rates won't parlay back into Australia. What drives our interest rate regime in Australia is inflation and GDP, but mostly inflation. And our Reserve Bank has made it pretty clear they don't want to review the inflation indicators, and the inflation indicator they set this in 1996 is between 2 and 3%. So inflation has to sit between 2 and 3%. And I'm talking about adjusted inflation, not inflation that's affected by increase of tobacco prices because the government put a new tax on there, or not increases in liquor prices because the government put a new tax on there, or not the increase in car prices because of COVID, or not because of the increase in electricity because there's been a government rebate's been terminated. They adjust the inflation numbers to see, does inflation actually still sit between 2 and 3%. And our Reserve Bank has already said, and said it on a number of occasions, and our Reserve Bank's pretty transparent, and they do it on the 2/31 on the first Tuesday of every month, except for the month of January. They come out, and it's in a couple of pages, and everybody can get access to it. Just go to rba.com.au and you'll see latest release, 2/31, first Tuesday of every month. They'll tell you what they're thinking, and they do an analysis for the whole month of every country in the world, or most of the countries, major countries in the world, and they do analysis of what's going on here. And they have said repeatedly every month, month after month, that interest rates will remain low for the medium term. And they define the medium term as 4 years, as of what's now another 3.5 years from now. So I would have to say to you, based on what I have analyzed, as opposed to what I have theorized and what I've read, is that I don't think official interest rates are going to increase, until probably 2024 from here. Now, I think that's probably where I would leave it. 2024 is probably when we're going to see the next official rate rise. Of course, we are going to see inflation. I said before, inflation right now is running at 3.8%, but that's because of a whole lot of anomalies. Generally speaking, our inflation's been sub 2, pre-COVID, sub 2%. And the reason why it's running at 3.8% is because we came off a very low year last year. Like, prices didn't do anything last year. They just sort of sat around doing nothing. And people tended to save instead of spend. This time in the beginning of this year, people took their savings and they spent. So the money they saved, they spent in January, February, March, April, May, June, because they thought COVID was over. So, okay, we saved, let's spend. That's a pretty natural response. Right now, we're back into saving because COVID's back. And COVID's more severe now than it was before. So I'd be interested to see in January next year what the net saving is. And I think our net saving is going to be even greater because more people are staying home across Australia than ever before in our history relative to where we were, say, this time last year. So I'd say that net saving is, I think the inflation number of 3.8% we saw in June, we're going to see a net inflation number in December, which gets printed late January, of probably around the other way, minus something. So, and because we're going to have net saving. And then probably what will happen is when we all get released or get Freedom Day comes again, because of vaccinations and all this complicated government health policy, whenever that happens, we'll see spending kick off again. And the Reserve Bank will look at us and they say, okay, that's just a overreaction to the pent up demand that resulted from the lockdown period. So my feeling is 2024 is when we'll see Reserve Bank put rates up in a meaningful way again. I don't think we'll see them at 25 basis points increases like we traditionally see them at. I think we'll see them at something like 10 basis point increases. The Reserve Bank will eke it out. That's not going to have a huge impact on the cost of funds to the lending environment. You would hope that the retail rate only goes up by 0.1 or 10 basis points or 0.15, sort of close to what the Reserve Bank puts it up by. And I think if they do put interest rates up, Greg, they'll do it by small amounts, like in very small increments, just to see what effect it has over a 6-month or a 12-month period. And they'll do it in a series, but they'll do it very, very slowly. To answer your question, 2024, very slowly, small increments.
Right. Mark, real estate can't just keep going up, going up, going up, and we all die and go to heaven. It's not going to happen. Now, earlier in the show, we had Phil Anderson. I don't think you know Phil, but Phil's he lives in Jakarta and very, very well respected property analyst. He was with Port Phillip Publishing, a massive following, big subscription, and he's had his own research. Now, what I'm about to tell you, what he said, you will be very impressed with, I think. And Phil Anderson is saying that according to his cycles, and he's been saying it for 10 or 15 years or plus, that we will not see the top of the market until 2026, 27 in Australia. What do you, now, surely, now I know you and I had this chat many, many times over the years because I've had Harry on my program, and because Harry's a lovable rascal, but of course, Harry's just playing the research, he's playing the demographics, he's saying that the real estate market should have adjusted by now, but it hasn't.
Eventually it will, because if you keep saying eventually he'll be right, but it hasn't. I agree with you.
Oh, you're funny, Mark. You said that to me about 5 times. And you're right. But listen, we're not there yet, are we? We haven't got to the top of the market. So here's your chance, Mark Bouris, well-respected statesman of Australia, decorated. Well, here we go. What's the top of the market?
Well, I'd say it's probably prior to 2026 or 2027. My gut feeling, and it's not analyzed, it's not I think we'll see the top of the market around 2024. So I think the way borrowers are today and us as lenders are today, the moment we have to start assessing it, I'm making an assumption here, by the way, the real wages continue to remain fairly flat. In other words, we don't get massive increases in wages in Australia, which I think all the indicators would say that is going to be the case. So we will start assessing borrowers in 2024 when interest rates start to rise at a higher base. And because interest rates are rising, we'll be required to add a bigger threshold to the assessment process. So let's say we're adding 1.5%. In a flat market, that is where no one's expecting interest rate increases, 1.5% threshold buffer is a fair buffer. In an increasing interest rate environment, you can't use a flat buffer. You have to have a higher buffer because you expect interest rates to rise. So when we start assessing your ability to service the debt I'm going to give you in 2024, when interest rates start to increase, your ability to borrow money from me will be far less than it is today. In which case, I will lend you less money, or relatively speaking, proportionally less money than I am today, relative to prices, which means you'll be able to pay less, or you won't be able to pay as much, or you will only be able to pay less for the same property, which means either you've got to have built up a much bigger deposit, which is unlikely because wages are not increasing and you're not saving more money, and the cost of living is not decreasing, so therefore you're not saving more money. So you're either going to have to come up with a much greater deposit, which is unlikely, or I'm going to have to lend you more money, which I'm not going to, because I'm now assessing you on a higher threshold and a higher base rate, which means you can afford to pay less money for the property down the road, and not you, but everybody, which means the bidding will stop at wherever the prices finish at. So like in 2024, let's say the average house price is $1 million, you're not going to see any more price increases from that point on. That's what I think. And because I think what's going to drive price increases is affordability. What drives affordability is basically how much money I'll lend you and what the interest rate is that's being applied to it. And you're not going to be able to borrow more money unless you get more money than I'm prepared to lend you, unless your wages have increased, which I'm saying will not be the case. And I know that interest rates are going to go up, and I'm saying interest rates are going to go up in 2024. And I know I'm going to have to apply a bigger threshold to you, because that's what the regulator is going to make me do, which means you're going to be qualified for less borrowing. And unless, as I said earlier, unless you've got a much bigger deposit. Now, that's what brings me to this regional discussion. If you want to arbitrage the market and get beyond 2024, the only places that will get beyond this theory that I just put to you is regional areas, because what could happen is people will say, especially by then, you know what, I can work and live, and I wouldn't mind living in, I don't know, let's pick a place, Byron Bay, Ballina, Lennox Heads. I wouldn't mind living there. I now currently live in Sydney. I've got a mortgage of, $1 million. My property's worth $2 million. I've got $1 million equity. One way you can increase the equity, even though I'm going to lend you less money because of your salary, is sell what you got, take that $1 million equity out and go and buy something for $1.5 million, which means you've got much more equity. You only need to borrow $500,000, which means you can then afford to pay much more for that property in Lennox Head than anybody else. So everyone else who lives in Lennox, who's only got the amount of Lennox equity, they're not going to be able to outbid you because you've got more equity. Even though I'm not going to lend you more money because of your salary, I'm going to lend you less money, but you've got more equity because you sold something in Sydney. So I see there being an arbitrage in 2024 in regional areas when people start to say, you know what, I can work from anywhere because of the digital environment. And I want to get out of Sydney because it's too expensive and I can't increase or upgrade my property, or I can't afford to buy property at all. And I'm going to go into the regional areas. That's what I think. I think there's a definite arbitrage there, Greg.
Mark, I want to talk about the elephant in the room. And you're going to say, what's the elephant in the room? The elephant in the room, in my opinion, is this COVID virus.
Yeah. Like
you, I walk around Sydney. I live out in the Crow's Nest area. More and more shops closing. You speak to the local cafe people, they're hurting badly. You've got hotels mothballed. You've got airlines across the world, airplanes mothballed. You've got all of this uncertainty. You've got, and just recently on my show, I had Harry Dent, Robert Kiyosaki, Jim Rickards, very, very clever guys that the central bank get intelligence from the likes of Jim Rickards. Every one of them have said to me, we're heading for a Great Depression. I mean, they've given the biggest gloom and doom on my program. You want to race off and play with razor blades after you heard them.
Okay, well, let me comment on that, Greg. I'll say that if the vaccinations work against Delta and any variants, then I think that we'll be out of this lockdown come February, March next year. If I could look at the experience of I'm not talking about America, by the way, I'm talking about Australia. If I can look at the experience of what happened in January, February this year, when we were back to living our normal lives, and admittedly we had 0 cases, but if 80% of the population is vaccinated, and if you get a mild version, you don't get hospitalized, you're less likely to die. Let's remember that the 20% of the population that don't get vaccinated are usually going to be kids, little kids, or the 20% of the population that decide not to get vaccination might have some issue around vaccination or have some religious view on it. They're more than likely not necessarily represent a big proportion of property buyers in Australia, particularly if it's children. 80% of the population is pretty much the 30 to 60-year-olds who buy real estate in Australia. They'll still be able to go to work. I'm making an assumption, by the way, that we do have a release day, a freedom day. You know, I'm making that assumption, and from all indicators, that's what the governments are trying to do. But I'm making that assumption. The small businesses you're talking about, that is going to cut into us for a long time. And there are a lot of these people who are out of business. And hotels the same, and travel agencies and airlines. But you've got to look at what percentage of the population, of the residential housing population that are buyers, or the demand, what percentage of the demand of buyers do those people represent? And if they do already have property, then they'll sell it and someone else will buy it. So question then becomes, will that cohort of people who those three individuals mentioned represent enough of the stock of housing in Australia to create a supply shock to the Australian property market? And if they do, how long will that supply shock last? And are there natural buyers for those properties? As I said earlier, there's always a bargain property buyer. There's always someone who's going to buy a property for bargain, because those people, they still exist. They're not dead. They're maybe bankrupt, or they've gone out of business, they've got no income, but they've got to live somewhere. So, you know, they might be your renter. They've got to rent property. So, and they might not be able to pay the same rent they were paying before as a mortgage holder, but if I'm buying that property much cheaper because they're selling it at a discount into the supply chain, then I can afford to rent it to them at a lower price because I'm expecting a lower yield. So I think what you're saying and what they are saying is quite possible. There could be a short-term economic shock in Australia. Forget about the rest of the world. Australia only, I'm talking about. There could be a short-term shock, but I think the balance sheet of Australia, and I don't mean the national balance sheet, but I'm saying the balance sheet of the population, and bear in mind, still 60% of all Australian mortgage holders are more than 2.5 years ahead of schedule on their mortgage repayments. 2.5 years. So they've built up all this advanced payments, which is basically a saving. So 60% that still exists today. Those people, I think, will take up the slack. I think those people put us in good shape, and that they will be out. So we're looking at 40% who are on schedule. Below schedule today, it's probably like 1%, 1.5%. So if 1.5% of the total population, or the total supply of housing in Australia is put on the market again, yes, that will create an economic shock for a short term. My gut feeling is that people will go and buy that excess stock up. I'm certainly the sort of person who would do it. I mean, if I can buy, apartment at a really cheap price discount, and I'm happy to do that because I know I'm happy to get a lower yield because I'm paying a lower price. There are a lot of people around ready to do that, and I think that supply that will be mopped up. I'd say, therefore, I'm only guessing now, but if they're correct, these individuals are correct, then, and I'm assuming again that we don't get another variant that's the vaccinations they work on. But if they're correct, we might have a shock beginning of next year, and that shock might last for a 12-month period. By the way, in which case, I know the government will lean into this, both federal and states. Our federal and state balance sheets are still AAA rated. These other countries that are talking about do not have AAA rated balance sheets. Australia is one of the few countries in the world. New South Wales, for example, is one of the few states in the world that still have a AAA rated balance sheet. America doesn't have one. US doesn't have one. Our very dense country does not have a AAA rated balance sheet. We can borrow money. Our governments lean into property markets. I'll tell you now, Greg, in August last year, Josh Frydenberg rang me up, and they were talking about, what he's going to do in terms of policy, government policy. And he said, one thing I will make sure that doesn't happen. He says that the construction and the housing industry is not going to cop it in the head. So he went out of his way to put so much money. They put out 90 billion, the Reserve Bank through the government put $90 billion on the table to the four major banks to lend at less than 2% fixed rate into the marketplace to allow people to continue to sponsor the property market. And the reason for that is not because of love affair of property. The government understands that creates a wealth effect in this country, and therefore stops recessions. People will go and still spend. So the government can still borrow that money for ridiculously low prices because of the AAA balance sheet we have in this country and the states. Where I think the biggest issue is if we start getting re-rated as a country or as New South Wales as a state, and then therefore interest starts costing us more for new borrowings and our old borrowings as well. That's the thing I'd be most concerned about if we get re-rated. I'm not concerned about COVID, lambda variants or any other variants. I'm not really concerned about those things. I'm not so concerned about the cohort of people who, as you say, are doing it tough and may well have to sell their properties. I'm not so concerned about that. That's more to me is shock, but only short-term shock, which I think that supply will get taken up. Where I'm most concerned is our global rating as a country, in other words, and as a state in New South Wales, which affects our ability to borrow money to support the industries you're talking about. And so far the government's done a pretty good job of that. So I would be concerned, for example, if we had a change of government in election next year, federal election, I would be very concerned about that, because I would say that the rating agencies would consider the government spending will change. I mean, in terms of, I'm not talking about to support property industry, but just generally speaking, big governments come with Labor, and both in state and federal. We don't have a state election next year, we have a federal election, but I would be concerned about that. And then all of a sudden the rating agencies start to look at our rating, therefore affecting our ability to borrow money and our ability to put money back into the property market. I would equally be concerned, to be frank with you, if a Labor Party got voted in, about what the Labor Party would do to negative gearing and capital gains position in relation to investment properties in Australia as well. And I think those things, and your listeners are going to start thinking about this. If you don't want if you don't want the property market to die because you're invested in it at the moment, as opposed to someone who's looking perhaps to invest in it, hoping it will die. But if you don't want it to die, then you better start thinking about who you're going to vote for this time next year, because that will be a massive determinant in our ability to borrow money and etc. Just generally, and the environment in which we operate our residential property market.
Mark, look, we're coming to an end, and since I first met you in 2011, you've spoken at many of my events. You've always been so positive, and in actual fact, so much of what you've said has actually come true. And
so positive and so correct, Greg. So that's the issue. I've been correct. I haven't been incorrect so far.
No, I know that. In fact, we've met at the football a few times, and you've made a quick little uppercut on me a few times, which I appreciate. It's very nice, and everything. But look, you're a man that's travelled. You've mixed with some of the best business people in the world, the politicians in Australia and whatever. I'm going to put the acid on you here. There must be a good story you can give us, a story that you've met different people or something that's happened to it, a business advice, personal advice. Come on, there must be one of your 151 stories that you can leave with my viewers. Give us a Mark Bouris special. Okay,
all right, I will. Kerry Packer once asked me, he said to me in 2004, beginning of 2004, he said to me, when he and I were in partnership with Wizard, he said to me, son, he said, how much money, how big is our mortgage book? In other words, they're out because I'm a lender, that's an asset for me. When I lend you money, that becomes my asset. When I borrow money, in other words, people put money in deposit with me, or if I get money, any type of money in, that's my liability. And he said, how much is our mortgage book? And I said, at that time was $19 billion. He said, oh, that's great. And he said, and how much do we owe? I said, $19 billion. Because, we fund every mortgage by debt. It wasn't my money or his money. We used to fund it by debt. And he nearly died. He went white, pale. And he said to me, I said, but don't worry. I said, that $19 billion, which I've raised around the world, I'd raised it through all the major corporations, like Bill Gates Foundation, all sorts of, Merrill Lynch, everybody, all around the world. I'd raised $19 billion in various currencies, in sterling, euros, and US dollars. I raised it in, and I said that $19 billion is, in terms of my currency exchange exposure, it's hedged. I've hedged it with 3 of the major banks in the world. No, I bought hedging contracts. I said the interest rate difference, so when I borrow money in pounds or US dollars, the interest rate I borrowed was a lot different to the interest rate I lend in Australian dollars. I said I've hedged any interest rate movement with 3 major global banks around the world. And I said also the thing called prepayment speed, in other words, the speed at which I have to pay our liabilities back are exactly book matched to the speed at which our borrowers pay us over 25 years or 30 years in those days. And I said, and that's hedged too. And he said, that's great. But he said, and this is in 2004, he said to me, but how do you know that and I used to pay enormous amount of monies to these hedging counterparties, they're massive banks, and I won't name them. And he said to me, how do you know that they're good for it? I said, well, come on, Gary, they're globally rated banks. He said, son, I think it's time we sell our business. And we sold our business in December 2004, 1 year later. Well, just 11 months later, we sold to General Electric. And what's amazing, and I just could never understand it, why he wanted to do that, because we were making like 80 million bucks a year. It was a great business. And I just couldn't understand it at the time. Of course, fast forward to 2008, the wily old fox had passed away. But the wily old fox, what he knew was that when you think everything is perfect, that the hedging counterparties that we had, 2 of those hedging counterparty banks don't exist today.
Wow.
They were major global banks, American, both of which have been subsumed by other banks. But they were 2 of the big banks that went down, amongst many, went down in the late 2009. So I think the lesson I got out of that was, many years later, the lesson I got out of that is, and here I am saying everything, I think on the balance, everything's going to be pretty good for Australian property. But even if I sound convincing, and you can equally reverse it if it's Harry Dent, you can say, even if he sounds convincing, it doesn't matter how well rehearsed or how long you've been sitting at something and doing something or looking at something or analyzing something, something can go wrong. And that's Kerry's view. And sometimes why he was such a great gambler, which is why Kerry was not allowed to gamble in so many casinos in the US, in Las Vegas, because he won too much money, because he would take the money off the table. And Kerry made me take the money off the table with Wizard. He said, sell. Mm. And well, he wanted to sell. I didn't, but I couldn't hold. He had 50%, I had 50%. So I had to sell. I couldn't hold 50% on my own. So I guess the lesson out of that, life lesson of that is, if you're doing really well and you're making lots of money, and you might be thinking to yourself, should I sell my property right now? Is this the top of the market? Don't worry about it. If you're making good money, sell it.
Well, he did always say there was only one Alan Bond.
Correct. You only get one Alan Bond in your life, and sort of the lesson with that is you're only going to make money on one really good money on one occasion. Don't think you're just going to keep repeating it. And Kerry was never someone who'd be betting at the gambling. If he's losing, he'd just keep betting and then he'd walk away. But if he was winning, as soon as he won a certain amount, he'd take the money off the table and walk away, which is what the casinos hated. That's why he was barred from a lot of places, because he could win big and he could hurt them. And he was like that with business too. And doesn't matter how good everybody is and how good the pundits are and who's been correct and has Mark been correct for the last whatever. It doesn't matter. It's irrelevant, because one day you're going to be wrong.
Exactly. Mark, our time is up. Again, wonderful to be with you. Your positive attitude is a credit to you. It's great for Australia to have somebody like you with such a fantastic positive attitude, and not just today, but for a long time. And so it's so important for everybody to hear that. So thank you. We'll get you back again real soon, eh?
All the best, Greg. See you, mate.
Okay, mate. Bye-bye. Thanks for watching. If you enjoyed the video, please click on the like. Also, make sure you're subscribed to the channel. And also, lastly, click on the bell so you can be kept up to date with all the information coming in from the GoGo Group. Once again, thanks for being with us, and we look forward to seeing you real soon.